welcome to my next video. In this video, we will talk about how to invest. Specifically, we will talk about asset categories that you can invest in. This video is part of a 6-part series of videos on how to be a better investor. I highly recommend that before you take any actions based on this video alone, you first check out all the videos in this series. But first, what I say in this video is based upon my education, my life experiences, and my set of values. What I say is for typical people in typical situations. It is not for all people in all situations. If it was, this video would be hours or even days long. My goal and hope is that by the end of this video, you will know more about how to invest, and you can make better decisions for your life. Everyone agrees that there are at least 3 broad asset categories that you can invest in. Those 3 asset categories are cash, bonds, and stocks. There are way more asset categories than those 3, but those 3 are the core asset categories. Any asset category can be sliced and diced into smaller pieces. Depending on how much money you're investing, it may or may not make sense for you to slice and dice your asset categories. If you're investing $1,000, using the broad asset categories of cash, bonds, stocks is just fine. If you're investing $10 million, it's probably worth your while to slice and dice your asset categories a bit. So let's talk about these 3 asset categories. The first asset category is cash. Some examples of cash are bank accounts, money market funds, certificates of deposit or CDs. The asset category of cash has low investment risk. This also means that the asset category of cash has low investment return. Cash is safe, cash is stable, cash is low risk, and cash is low return. Safe, stable, and low risk. These are all important if you are investing something today and you might need the money soon. Cash is a great place for you to put money that you may have for an emergency fund. Cash is also a great place for you to put money for a purchase within the next couple of years. Over very long periods of time, the investment returns from cash have been roughly equal to the inflation rate plus a smidge, less than 1%. Today, the investment returns in cash are way lower than this. The second asset category is bonds. Bonds are where you loan money to a government or a company. Generally with a bond, you get paid interest every year or so. How much interest? That depends on the overall interest rates and how risky the bond is compared with other available bonds. In addition to interest, when the bond loan is up, you get paid the money you originally loaned. When you invest in bonds, you have 2 main risks. First, you might not get paid what you're owed. Second, you do get paid what you're owed, but because inflation was higher than what you originally thought it would be, when you get repaid, it doesn't buy as many goods and services as what you originally thought it would. Bonds have a higher investment return than cash. That means that bonds also have a higher investment risk than cash. While the return on cash is very stable, the return on bonds, not so much. Over very long periods of time, the U.S. bonds' worst year's investment return was down, not up, but down about 8%. Over very long periods of time, the investment return from U.S. bonds have been about roughly equal to the inflation rate plus about another 2% or 3%. You can slice and dice the asset category of bonds many different ways. I'm just going to talk about 3 different kinds of bonds. Classic U.S. government bonds, inflation-adjusted U.S. government bonds, and investment-grade U.S. company bonds. There are many, many other kinds of bonds. Generally, classic and inflation-adjusted U.S. government bonds are seen as one of the safest investments in the world. The U.S. government has a flag. The U.S. government has an anthem. The U.S. government has a long history of paying its bonds. Even better than all of these, the U.S. government has this big printing press, and it can print more U.S. dollars to pay its U.S. government bonds anytime it wants to. Classic U.S. government bonds pay you a fixed interest rate every year. If you live in the United States and your lifestyle costs are paid for with U.S. dollars, the only risk in buying a classic U.S. government bond is the risk you get paid what you are owed, but because inflation was actually higher than what you originally thought it would be, what you get paid buys you less than what you originally thought it would. That's where inflation-adjusted U.S. government bonds come into play. Inflation-adjusted U.S. government bonds pay you interest at the inflation rate plus, and occasionally minus, an additional fixed rate of interest. When you get paid at the end of your bond loan, you should be able to buy exactly what you originally thought when you invested in the U.S. inflation-adjusted government bond. When you buy U.S. inflation-adjusted government bonds, you've taken the inflation risk out of your bond investment. Now, 2 additional things about bonds. First, I feel I should point out that it is the same U.S. government that calculates the inflation rate, and then after it's calculated the inflation rate, pays you your interest based on the inflation rate it just calculated. Now, I am not saying that the U.S. government is calculating the inflation rate too low. I'm just pointing out that the U.S. government has an incentive to calculate the inflation rate too low. The second thing I want to point out is that in August of 2020, when I'm recording this video, the overall interest rates are low. Really low. Historically low. Shockingly low. These days, inflation-adjusted U.S. government bonds have a minus in front of the fixed part of the additional interest rate, rather than the typical plus in front of the fixed part of their additional interest rate. What that means is that today, if you invest in an inflation-adjusted U.S. government bond, because of the negative fixed part of the additional interest rate, you are guaranteeing that your investment return will be less than inflation. You are guaranteeing that in the future you will be able to buy less goods and services. Not good. The whole idea behind investing is that you grow your money over time, not shrink it. In addition to the bonds of governments, you can also invest in the bonds of companies. Investment-grade U.S. company bonds are bonds from U.S. companies with a high credit rating. But even if a U.S. company has a high credit rating, it still does not have that big printing press to print more U.S. dollars anytime it wants to. Because of this, U.S. company bonds have higher investment risk. than U.S. government bonds. These higher investment risks also means that U.S. company bonds have higher investment returns than U.S. government bonds. When you decide how to allocate your investments between U.S. government bonds and U.S. company bonds, the key question for you is, does that higher investment return make up for that higher investment risk? That's for each one of us to decide. If you are looking to invest in bonds, you may also want to consider the bond-like investment equivalent of prepaying your debts. For example, let's say you have a student loan with an interest rate of 5%. If you prepay that student loan, what is your investment return on your prepayment? 5%. What is the investment risk that you will not get your 5% return? 0. A bond investment with a 5% return and no risk is a great bond investment today. Now, a potential downside of prepaying your debts is that depending on the debt you're prepaying, you may or may not be able to borrow that money again if you need to. For example, it's not a good idea to use all of your money to prepay your debts and then have no money to pay for an emergency. I highly recommend that you consider your whole money situation when you act. Don't just focus on one little part of your money life, like getting a good investment return. The third asset category is stocks. Stocks are ownership in a company. The investment return from stocks are potentially the payment of dividends and potentially an increase in the price of the stock. Of the three broad asset categories, stocks have the highest investment risk and the highest investment return. Stocks go up and down way more than bonds. Over very long periods of time, U.S. stocks' worst year's investment return was down, not up, but down 43% in 1 year. Over very long periods of time, the investment returns from U.S. stocks have been roughly equal to the inflation rate plus about another 7% or 8%. You can also slice and dice the asset category of stocks many different ways. I am just going to talk about two different kinds of stocks: U.S. listed stocks and foreign listed stocks. U.S. listed stocks are stocks that are listed or traded on U.S. stock exchanges. The U.S. stock market is large, liquid, stable, and by world standards, a relatively well-regulated market. If you are investing for the long term, and if you can really live with U.S. stocks investment risks, U.S. stocks are generally thought of as a core part of your investment. Now, U.S. listed stocks are very roughly half of the world's listed stocks. What about stocks outside the United States? How much should you invest in them? Well, reasonable people can and do disagree about this. My perception is that these days, the normal recommendation by reasonable people is that of the total amount of your investment you're putting into stocks, about 30% to 50% of that should go into foreign listed stocks. In this video, we learn more about how to invest. Specifically, we learn more about asset categories. This video is the third part of a 6-part series of videos on how to be a better investor. If you want to learn more, be sure to check out the other videos in this series and my other videos on many other topics. Until the next video, always remember that you are the best person in the world to decide what is important in your life. Thank you for watching. Please click the button to subscribe. I hope that you got something from this video. If you did, please give it a thumbs up and comment. Please check out my channel, playlists, and other videos. Have a great day.